Thank you, Amrik, for the introduction. It's a great pleasure to be here and to be able to share the results of our project. It's been a really interesting journey with our team and with Amrik and Lucania throughout these few months to deep dive into the Finaccess data. So we are glad that we are able this morning to share some of the results of our research. The objective of our research was to create a toolkit that would allow to measure financial inclusion over a long period of time, with the idea of being able to track and measure Kenya's financial inclusion journey. And in terms of financial inclusion definition, we set from the start a higher bar, whereby we did not simply consider a binary measure of included, excluded by looking at whether an individual has or an account, but rather at whether this individual has access to a full set of services such as credit, savings, and insurance and pension. So as I was saying, so we in terms of financial inclusion definition, we set a higher bar, not to look at simply a binary measure of included, excluded, by looking whether an individual own or not an account, but we considered a full measure of access to a full range of financial services, such as credit, savings, insurance, and pension. We then created a series of indicators to measure how much individuals are included based on the set of products they have access to and understood as usage. And to simplify, although we'll take a look a bit more in detail at the indicators in the following slides, in our indicator, if an individual uses a broad range of financial products, she obtains a high score, while if the same individual has a small range of products, she will obtain a lower score. We then categorized products between formal and informal and created two sets of indicators. One that measures the usage of financial services regardless of whether they are formal or informal, and another that considers the formality dimension within an individual's product portfolio, giving then a higher score for the usage of formal financial products. And in addition, in order to better understand financial inclusion in Kenya, we wanted to look at different segments of the population to understand which ones have benefited more throughout the financial inclusion journey. And we considered different population characteristics. So we look at gender, age, residence, as in rural versus urban, education levels, sources of income, and location, for which we used the previous Kenyan provincial categorization, because we wanted to be able to track this over time, and based on the data, this is the information that was available over such a time span. And finally, the idea is also to be able to use these indicators and test them when we want to analyze the impact of certain events, for example, shocks such as the impact of the COVID pandemic, as well as the introduction of innovation as for example, mobile money. In the following slide, we will provide a taste of some of the results that we have obtained using our indicators. But the main idea that we want to put forward is that we wanted to create a flexible tool that allows to measure different aspects of financial inclusion over a long period of time, considering a more meaningful definition of inclusion that looks at access of a full financial, of a range of financial services. So in this first slide, we will look at both our formal and informal indicators to measure the percentage of the population that is relatively excluded when we consider access to a full range of financial products. So the first indicator, it's the formal indicator, where we have set the score between 0 and 26, depending on how many products are used. And we have set a threshold at 13, which is the score that an individual obtains if she has one formal account and two other formal products, like a loan from a formal financial institution or a saving product. We decided to set the threshold at 13 because we have seen from the data sets that a large part of the population was around this score. So from the graph, we can see that based on this logic, we are, and based on this more meaningful measure of financial inclusion, a large part of the population can be considered still partially or relatively excluded because they don't have access to a full range of financial services. We do, however, see also a declining trend of this indicator between 2006 and 2021. If we now take away the formality and look at products irrespective of this dimension, so we can consider, for example, an individual with a CHAMA member and will have an account and likely also credit and savings, we see that we obtain a similar pattern and trend. So following a similar logic as for the formal indicator, we set, for the neutral indicator, we assign a score between 0 and 9 with a threshold at 5 for individuals who have 3 products. So the threshold at 5 is again because we saw from the data that's where a large part of the population was. So the same way as for the formal indicator, we see that a large part of the population remains partially excluded. And when we look at the two indicators together, we can really appreciate the similar pattern and trend over time. We then move on to look at two other indicators that we have created. The first one is a simple count indicator, whereby we simply consider the number of products used. And when we consider a score of 0, we see that based on our calculation in 2021, 13% of the population still has no product whatsoever. The second indicator is a little bit more complex and is an attempt to measure how inclusive or exclusive a product is. It can be, in a way, considered as a proxy to measure equity, and in the sense that we look at whether an individual is relatively more excluded if she's not using a product which is widely used by other individuals within the same population characteristic. So here, perhaps we can use an example to explain these indicators, moving away from financial. Sorry, yeah, you're right. Yeah. So yeah, move away a bit from the financial product example to explain this indicator a little bit better. So if I own a luxury car, which is considered to be an exclusive product, by this indicator, I will obtain a high score. However, if I do not own a luxury car, I will not be strongly penalized because by definition, a luxury car is owned by only a few individuals. However, if we look at a different type of product, like a small car, which is owned by a large part of the population, I obtain a low score compared to the individual who has a luxury car. But if I don't own it, I get strongly penalized because I'm not using a service that a large part of the population is using. So by this indicator, we show that exclusion has decreased over time, but between 2013 and 21, only by 9%, showing that our equity proxy only marginally improved. We then moved on to look at the aggregate effect of across all waves, calculating an average over the entire data set. And in this slide, we show the average gap in the score for different population characteristics. So, for example, if we look at the gender population characteristic, we see that the score for women is on average 7% lower than the score for men when we look at the neutral indicator. However, if we consider the formality sensitive indicator, the gap is much larger at 15%, indicating that there is a substantial difference in the use of formal financial services between men and women. And in a similar way, when we look at residents, we see that rural dwellers are in general more excluded relative to urban dwellers. And the similar thing for youth that generally score less than adults. And finally, if we look at education as a characteristic, the uneducated population score considerably less compared to the population with tertiary education, with this gap decreasing as the level of education increases. This large gap, which we will see also in other results, seems to indicate that education is a strong determinant of financial exclusion rather. We then looked at the change between 2006 and 2021 in terms of catching up and filling the gap. And we can see from this slide that some categories have been catching up while others still lag behind. So this result shows that, for example, always in the case of the gender characteristic, the neutral indicator for women increased by 14% more compared to the indicator for men. And so this higher indicator indicates that women have been catching up to men in terms of financial inclusion. So we see a definite improvement for female for the neutral indicator. However, when we look at the formal indicator, we see also catching up, but at a much lower pace. So in the same way, we can see that other categories like rural dwellers, the score grew, for example, 21% less compared to urban dwellers. And here we indicate, this indicates that urban dwellers still lag behind compared to their urban counterpart. And similarly, we see a similar trend for the education characteristic. And for youth, we see some sort of gap remaining, but reducing, particularly in the use of formal financial services. So we then did the same exercise by looking at the main source of income. And here, our calculation is done using aid assistance as a basis for all other categories, so to also make them comparable. And in terms of the gap, the data indicates that government employees tend to score higher than all the other categories, while when we consider change through time, business owners show the strongest improvement. And again, we did the same analysis across regions, and we observed, particularly looking at the evolution through time. So sorry, here the base is against Nairobi. So we see that Nyanza and Western regions still lag behind with a significant gap, while Northeastern and Coast have been catching up over time. Then at this point I will hand over to my colleague Davide, who is online, and we will continue with the presentation of some additional results. Thank you.
Okay, good morning to everyone. Can you please show the presentation again? Because I don't see it. Okay, thank you very much. So, good morning again. So here what we have been trying to do is to analyze each population characteristic by holding the other population characteristics constant. And what we notice is that there are still some characteristics that play a major role. For example, age is very important. So the junior youth versus adult in terms of financial inclusion, as well as education is still a very important characteristic. So uneducated and individuals with primary education versus individuals with tertiary educations are much less financially included. The same if we compare individuals who depends on aid assistance or individuals who are employed in the private sector compared to government employees. So we see again the main results also here when we compare all the characteristics together. What we notice or what we can see is that when we control for all characteristics, including, for example, the province of residence or also the wave, we see that the financial exclusion of, for example, females is very limited. So it means that education, age, and being, for example, employed in the public sector are much more important than other characteristics. Okay, let's move to the next one, please. Thank you very much. Here, the model that we saw before was, the base for most of the other analysis that we did. For example, here, what you see here is a comparison between the financial inclusion of individuals in 2019 versus 2021. Here, we wanted to look at the impact of pandemic, and so how the indicators changed during 2021. And again, what we notice is that junior youth and uneducated individuals were the most impacted by the pandemic, while, for example, the rural population of women, their change was not different from urban population or the male population. So it means that they were not affected by the pandemic. So, and we also noticed that there was an impact especially in the access to formal financial service, a negative impact for government employees, but we have not been able to find a proper explanation so far of why they were so impacted by the pandemic. Please, next one. Thank you. Then what we did was to also look, we used the base regression analysis to look who were the main adopters of mobile money in 2013, and then to look at the performance of mobile money adopters in the following years. Okay, so what we notice is that there are, again, here three characteristics that play a major role in explaining the probability of adopting mobile mobile money. The adults versus junior youth. Okay, again, so individuals with tertiary education versus individuals that are uneducated or with a lower level of education, and then government employees. So what you see is that there are still three characteristics, major characteristics that also explain the probability of adopting mobile money. We also notice that if we control for all other characteristics, so we hold all other characteristics constant, we can also notice that in the case of females, with respect to men, there is a a small higher probability of adopting mobile money, but that's I mean, we notice that only when we control for all other characteristics. While in the case of the rural population, they were less adopters of mobile money in 2013 with respect to the urban dwellers. So you see here also the same dynamics that we have been seeing so far. So next one, please. And then finally, what we did, okay, that was the main characteristic that explained the adoption of mobile money in 2013. And then we wanted to look at how mobile money adopters perform in the next waves. And so what we notice is that the adoption of mobile money has been a very important driver of financial inclusion in Kenya. And you can see how the mobile money adopters they have been performing at a much higher level of financial inclusion for all types of financial inclusion indicators. They also were less affected by the pandemic, as you can see, while in the case of the no users of mobile money, they were affected by the pandemic. So they saw their financial inclusion to diminish during the pandemic. So these suggest that the digital revolution has made a major impact in the financial inclusion in Kenya, but has also created a gap between adopters, users, and non-users of mobile money. So yeah, that's the main message here. Okay, thank you very much.
Okay, thank you, Davide. So yeah, as just to conclude, as Davide was saying, we have seen that financial inclusion clearly made a huge impact in terms of improving financial inclusion, although for those who remain excluded, it may be a divide that can increase exclusion and inequality, and which may have strong implications for the participation of these segments that are excluded in the wider economy. So it stresses really the importance of reaching that last mile of the population. And in addition, as a general conclusion, we can say that by looking at this broader measure of financial inclusion as the usage of a broader range of financial services, there remains a large part of the population which is partially excluded. So that still a lot of work needs to be done. Sorry, just saw myself there. So yeah, sorry. So it's indicating that there is still a long way to go to improve financial inclusion using this broader measure. So thank you very much for your attention, and I hope you enjoyed the presentation. Thanks.
Lynette and Moses, that was a real sort of tour de force. It was a fantastic piece of work. And now I'd like to introduce Christine, who will give our next presentation on fair consumer outcomes.
Okay, I think we're all set up without any glitches. So as Amrik said, I'm here to talk to you a little bit this morning about the insights that the FinAccess survey can render on what I always see as a very tricky balancing act that regulators throughout the developing world globally indeed need to balance, need to find. And that is that on the one hand, you want to promote financial inclusion, you want to promote innovation and all the benefits that come with that. On the other hand, and especially as risks increase in the light of digital financial services, as consumer vulnerabilities continue, on the other hand, you want to make sure that there's adequate consumer protection in your market. So it's always sort of finding this fine balance. if you have to strike that balancing act, it's useful not only to look at measures of financial inclusion, as we saw now, that tracks how many people are excluded, or what are the features of the excluded. You also want to know a little bit beyond just whether they are excluded, whether they're included, whether they use financial services. You want to know, are they actually getting value from what they're using? You want to understand the quality of the usage of financial services that you see in your country. You want to understand how protected and how empowered are consumers in practice. And that's basically what we set out to do through this deep dive. So we embarked on a journey to establish a proof of concept for a financial consumer protection outcomes index, which is a bit of a mouthful. I'll call it the FCPOI from here on. So financial consumer protection outcomes index that can track the overall effectiveness of financial consumer protection across the financial sector, and this is very important from the consumer point of view, because that is what makes FinAccess such a marvelous tool. Now, just to give you a little bit of context, when I talk about financial consumer protection, it's really a very multifaceted concept, and there are numerous principles and components and elements of financial consumer protection globally. You need responsible market conduct, you need fair pricing, you need disclosure, adequate disclosure, you need financial education, you need effective recourse channels. More broadly, you want to build a financial sector that instills confidence and trust in consumers. So you need to protect consumers' assets, prudential regulation. You need a competitive financial sector, so you need competition. You need data protection. You need cybersecurity to be in place. And you need a comprehensive regulatory framework that encompasses all these elements and sets up appropriate oversight bodies across all areas of the financial sector. So financial consumer protection is not something simple. It's a big task. And what I've put on the slide for you is just to give you a sense of, in Kenya, all the different pieces of legislation flowing right down from the constitution into the sector level and at a cross-cutting level across numerous different regulatory authorities, all contributing to this concept of financial consumer protection. Now, how do you measure it? Traditionally, if you're looking at financial consumer protection, each regulator would require their regulated institutions to report to them, and they would do their on-site and off-site supervision. And then you would be looking at things like, are you complying? Do you have the right policies and procedures in place? So it's sort of compliance output measures that would traditionally be tracked. You could also ask institutions to report on things like number of complaints and whether they had the complaints resolved. So then you're trying to proxy indicators of consumer satisfaction through the data that you get from the financial sector. However, if we say that we want to try and measure financial consumer protection outcomes from the consumer perspective, which we set out to do with this index, then you need to think about what are the indicators or the proxies that you can use that is framed from the perspective of the consumers. And that was the point of departure for our compilation of this financial consumer protection outcomes index. So the framework that we used, we found it useful to start off with the set of 6 fair consumer outcomes. So that's the FCO, the blue blocks that you see there. And that framework was developed by CGAP in line with the global treating customers fairly principle. So what it basically says is if you have a financial sector that treats its customers fairly, what would be the outcomes as they transpire, as they manifest in the lives of consumers themselves? Now they defined 6 such outcomes. First is suitability. That basically means that the products that are available on the market must be suitable to my needs as an individual on the ground. It must be appropriate to my context, where I live, my features, my household. Secondly, there's choice. When I'm in the position where I have to take up a financial service, Do I have an appropriate menu of options available to me? Can I actually exercise an effective choice that aligns with my realities and needs? The third one is safety and security. I think that's very front of mind for everybody. So is my money safe? Can I know that it is safe? Can I trust? And do I have control over my personal data and how that gets shared? The fourth one is fairness and respect. That means when I engage with a bank or an insurer or a SACCO, am I treated with respect? Do I feel intimidated? Do the staff give me due respect? And does that continue throughout my user journey? Then, voice. Am I able to communicate with my financial service provider? Do I have accessible channels to communicate with them? Am I able to raise queries and have it resolved? Am I able to raise issues and have it resolved? And then finally, meets purpose. Is my usage of financial services actually allowing me to take control over my financial life? Is it allowing me to better cope with shocks, with resilience? Is it allowing me to save or to attain or reach life goals? So is it meeting the purpose that it should for me as an individual? So those are fair consumer outcomes from the customer's perspective. To this, we then added 3 further components or elements to the index. Disclosure, or from the customer perspective, that would be access to information. That could be covered in those other outcomes as well, but for the purpose of this index, we decided to separate it out because it's a clear element of financial market conduct that manifests or lands at the consumer level. So we thought it would be interesting to also measure it separately. The same for financial education. Do I have the knowledge? Do I know concepts like interest? Do I understand charges, etc.? And am I actually equipped through the skills to act responsibly in the way that I engage with my financial services? And then finally, recourse, which we decided to split out from voice so that voice deals with queries and communication channels, and recourse says, if I have a complaint, can I have it resolved from the consumer perspective? So basically what the index does is just to try and measure as best possible from FinAccess each of these 9 components, and to then average the scores across to express it as an index value that can then be tracked over time, more or less to hold up the mirror to the financial sector to say, is it really doing what it said or fulfilling its promise in terms of fair consumer outcomes? Now, just very briefly in terms of the methodology, it was done over 3 levels. So if you read from the bottom up, firstly, we combed through the FinAccess survey to think through what would be the relevant sub-indicators from the survey that can speak to each of those 9 components. And these were then always expressed as a positive score. I'll explain to you now. Positive score just means that if you ask something in the negative, like if the survey asked, did you lose money? You would invert it to say, now I'm looking at the percentage of people who did not say that they lost money, so that all scores are expressed in the positive and they can be added up, like for like. Just to give you a sense, can't go into the details now, unfortunately, of the types of questions that were then covered in different types of indicators. So under suitability, we would look at whether people say, oh, I don't use it because the price or the functionality doesn't work for me, so it means that the features aren't really in line, or there were too many charges, it was too expensive, or minimum balance, or the requirement for a regular income. So it just means that the features are not in line with my needs. And we would track that across different, like if you're a mobile money customer, if you're a SACCO customer, MFI or bank. For fairness and respect, for example, we would look, there was questions in FinAccess on did you receive poor service? Maybe if you engage with a digital lending app, was there harassment? Did you not feel that they treated you fairly in the process? Disclosure, for example, where do you get your information? Who do you depend on? Were you surprised that there were hidden charges or fees that you didn't know of? So those are all sort of sub-indicators that can tell you a little bit about the outcomes that people experience relative to this indicator. And then just the last example, safety and security. would be something like, did you lose money because of fraud or cybercrime, especially on mobile money, but also across different other financial services. Okay, so that's where you start. You define the sub-indicators. Then out of the sub-indicators, you then compile a single weighted average score for each of the 9 principles. And I think it's just important to mention the weights. So weights just mean that we take into account how prevalent the underlying financial services is in the population. So if we ask both SACCO clients and mobile money clients whether they lost money, mobile money clients will get a larger weight relative to the fact that more people in the population have mobile money than belong to SACCOs, just as an example. And then out of that, you would then calculate the overall index as a single index measure. Index just means that it's stated relative to 100 in percentages, so that you can track progress over time. And then also importantly, differences between groups are then standardized as a gap relative to the total population score. So if the total population scored 20% and this group scored 11%, then if you state it relative to the total population as 100, then the group would have an index score of 55, and you could standardize the differences between groups. Okay, I hope that gives you a sense of the methodology, and I hope I do have enough time to now do the findings justice, because I think it's very interesting. I just need to state a disclaimer, because this is a statistics conference, that we are putting this forth as a proof of concept to be refined further over time. And it's not the be-all and end-all to say, oh, this is the score on financial consumer protection in Kenya. It's a measurement input as a contribution to the dialogue on meaningful financial inclusion in Kenya. Right, so if we add up whatever we could from the survey across all those sub-indicators, we get to an overall baseline score of 67%. I must say, intuitively, when I look at that and I see 67, I think, well done. Obviously, there's a comprehensive framework, and obviously the financial sector is coming to the party, and it is transpiring in the way that consumers answer relevant questions in the survey. Just looking at the overall is not that interesting, however. It's much more interesting to see what are the difference between the different components that we measured. Now here I must just make another disclaimer, and that is that the magnitude or the level of a specific indicator or component is very much dependent on the specific questions asked in that indicator and the incidences that we found for that. So for example, if choice just asks you whether you didn't have any other choice when you took up that service, it's not sort of that meaningful to say, oh, choice is 93% and something else is lower. So it's much more meaningful to compare progress in choice over time than it is to compare the score for choice to the score for fairness and respect, if that makes sense. Nevertheless, where an indicator is quite low, it does show that that is where there's most room for improvement in future based on what is measured in that indicator. So I hope that makes sense. So with that in mind, it's very interesting to see meets purpose. And I think this would link to what Amrik will discuss later on financial health, is the lowest voice, the people's ability to effectively communicate and feel that they will be heard with their financial service providers, and suitability, the functionality and the features of the products in line with the customer's realities. Now, progress over time. The FinAccess survey changed in 2019, so we can't really consistently track these indicators before 2019. And actually, the changes made then is what enables us to track a lot of these outcomes. There is small differences between the 2019 and 2021 survey. That means it's not 100% like for like, but if you take this as indicative, it is still very meaningful just to see that, you know what, actually there's been a slight increase in the index score from 2019 to 2021. And then again to see sort of where exactly in the different components did you see most increase, and meaningfully, which was the only one that dropped, which was meets purpose, and that dropped by 21%. Interestingly, we see financial education, for example, jumping quite significantly. And here it's interesting to dig a little bit deeper to understand what lies behind this 20% increase that we see. We see that this is largely driven by people's understanding of theoretical concepts, so being able, or saying that they understand what interest is, saying that they understand the charges, etc. And not by the other sub-indicators that looked at things like, do small businesses budget, or do you keep records, or do you as a household actually budget? So it's an increase driven by, let's say, theoretical awareness or knowledge rather than necessarily practical application. So again, just as we dig deeper into this, it's very important to always remember the context within which the questions were asked for these components. Okay, now what is also very interesting just to look at is how does the index compare across different groups? Mariangela's presentation mentioned how the uneducated and women and rural people are still at a disadvantage in financial inclusion. And it's interesting just to see that also playing through in measures of financial consumer protection outcomes. So firstly, if we look at gender, and remember, as I explained earlier, this shows the relative gap between different population groups. So don't look at it at the absolute values in the scale, look at the gaps that we see in the spidergram. So overall, there's a 6% index gap between men and women. So women are at a relative disadvantage, and it's interesting to see where they're experiencing the greatest disadvantage, namely in disclosure, financial education to some extent, meets purpose, and voice. Women, we also did some qualitative focus groups where it was very clear women feel intimidated by the M-Pesa agents or the banking agents, males sometimes. They feel harassed and intimidated by, and you're seeing that in their ability to exercise their voice. We also see a difference when we look at livelihood types, where the orange is those that are in formal employment, and the light green, those that are self-employed, and the rest would be more casual and farming, and dependents being those who receive remittances or gifts or are dependent on state. And it's very interesting again to see those biggest gaps. Where do they lie? Disclosure, so the access that people have to information, where they turn to for the information, whether they're able to borrow or save to mitigate a shock or to achieve a life goal, whether they're able to effectively communicate. Those in formal employment still do have, I think as expected, a definite advantage. As also expected, this picture then looks relatively similar by income level, because formal employment would be suggesting that you have a higher and a more regular income in many instances. So financial education, disclosure, meets purpose, voice, for all of them, having a higher income really does matter. So for me, it says that even though I said at the start that financial consumer protection is so multifaceted and a complex concept, it's even more complex because it's not only about financial sector policy, it's also about economic policy and improving livelihoods, and the two go hand in hand. When we look at age differences, it's also very interesting. This becomes a little bit busy, but I'm going to just try and help you navigate this. If you look at the blue ones, dark blue is the youngest and light blue the oldest. And you see the oldest, they lag behind in financial education, and for them, this was mostly due to not knowing, not understanding the terms. So it shows an education sort of lag that needs to be made up, that older people still feel. They are much less likely to feel that they can communicate and have a voice and have their queries resolved. And also in terms of disclosure and access to information, they lag behind. What is interesting for the youth is that, so the dark blue, is that they score very highly on suitability. And that was basically when they were asked, do you not have something because it's not the right features for you? They just didn't say that that was an issue, so it didn't come up as an issue. But where the youth do lag behind is under meets purpose. So especially for being able to use insurance or a loan to help them reach life goals, they don't feel that they're in a position to do that. So I just thought that that was very interesting. And then also when we look at location, so again it confirms the picture that we started to see from the first presentation. There is a substantial urban-rural gap. I think the relative gap is 12% on the index overall. And this just shows up the challenges that the financial sector still faces in effectively serving the rural target market. And again, it's just very interesting to see that where do you see these big differences lie? Financial education, disclosure, meets purpose, and then suitability and voice to a lesser extent. I'm nearing the end. You don't need to worry about the details of the slide. Just what I want to try and convey here is, as you would have seen in those spidergrams, in a lot of instances, there's not much variation across the groups. That would be for choice, safety and security, and interestingly enough, fairness and respect. So there's not much variation across groups within those indicators. Where you see more variation, be it positive or negative, would be on mostly meets purpose, and then your disclosure, financial education, suitability indicators. So that just tells us, if you're wanting to dig a little bit deeper, understand more what lies behind this, understand what can be done from a policy and market perspective, maybe look at those and just understand them a little bit better. Finally then, the implications. So, I do think that overall this index tells us, even if it's still indicative, that the financial sector is delivering on the promise of fair, financial consumer protection, and it confirms the significant progress in financial inclusion in Kenya to date. So it in no way negates that. But the underlying nuances that we saw across the indicators and across population groups do show us some remaining pain points. As I said, suitability, voice, meet purpose, those are particular concerns, especially for more vulnerable consumer segments. So understanding where the vulnerabilities lie, I think, is a huge part of the value that this index tries to bring to the table. And then obviously, if you want to further increase this score across all the components, it would require a concerted effort. It's not just a regulatory matter, it's not just a market matter. It requires a concerted effort. And what we try to achieve with this index is just to add to the dialogue by offering a stylized way that you can track progress over time, in addition to what you're doing to monitor market conduct, but from the consumer perspective. And we're also putting this forth as a proof of concept so that in future we can refine it further, find maybe a smaller set of proxies that are most likely to predict financial consumer protection outcomes for Kenya. Thank you.
Thank you very much, Christine. That was fantastic. It's very nice to see the flow of these presentations. Mariangela and Lynette there took us through the inclusivity of Kenya's financial inclusion journey and where we're still seeing gaps with respect to inclusion and exclusion. And then Christine's work sort of really takes us into some of the detail of what may or may not be driving that. So we're seeing quite strong outcomes in terms of the sort of the supply side and how the market is actually delivering to consumers. But we're also seeing there's some big gaps on things like meeting purpose, the extent to which the financial sector is able to meet consumer needs. And in fact, that's a very nice segue into this short presentation. Sorry, let me just get it to the beginning. That I will now give very briefly, just to round us off here before we go into the panel discussion. I just want to give us a brief taste of some of the work that we've been doing on financial health, because in a sense, what we've seen, we still have deeper levels of exclusion with respect to access to a meaningful range of products. We're seeing that finance may not necessarily be meeting the needs and purpose for which it was designed for consumers. And perhaps that might partly explain the result that we're seeing as well with Kenya's declining financial health. So this is a paper, this is a sort of just a taster, as I said, really, of a paper that Paul and I have written just to try and use the data to dig into what might be driving declining financial health measures. We're seeing rising levels of financial inclusion, but as you can see from the pink bars there, we're seeing more people struggling with lower financial health, and correspondingly the green shows that there's also a decline in people with high financial health across the population. So we've only, I mean, our analysis shows that only 15% of Kenyans, by our metric, can be considered to be financially healthy in 2021, whereas in 2016 it was 40%. And that's in parallel with the continuing growth in terms of access to financial products, financial inclusion. So we wanted to dig into what could be explaining that. And I think Christine sort of alluded to that in her talk just now by saying, actually this relates not just to the financial sector, it also relates deeply to the wider economy. So in terms of people's financial health, it's partly dependent on their liquidity, on their purchasing power, on the sort of budgetary capabilities that they've got. And we've really seen that these household budgets have been put under huge pressure between 2016 and 2021. One of the things that we've seen is rising inflation, which has put pressure on expenditures, particularly basic foods and services. I'm going to run through this quite quickly because I want to get to the panel discussion, but you can also read the paper on our website. We've also found that median incomes have either fallen or stagnated. And, oh, goodness, we can't see the bottom of the screen. Oh, it's okay, I think the legend is up there. So we can see that that's true across all wealth groups. We've seen declines for the poorest, poorest 20% of the population, sorry, poorest 40%, middle 40%, and the richest 20% of the population. Interestingly enough, the steepest declines have come within the richest segment of the population. That is our top 20%. And that really drives outcomes for the rest of the population, because as we know, many of our wealthier Kenyans actually support lower income Kenyans through remittances and social networks. So that has big reverberations and implications across the population. Part of the reason for this is possibly sort of the decline in the quality of jobs that we saw from the presentation yesterday. Again, Paul does these wonderful, slightly complex charts, but you can see the sort of squeeze in the dark blue and purple at the top. This is really the share of the population earning income from employment and business, which is actually reduced as a sort of a share of the total population. And correspondingly, the yellow at the bottom shows the increasing percentage of the population that are dependent on transfers, often coming from those top bands actually at the top. And then correspondingly, as Bobby and Jess discussed yesterday, we've had a huge increase in dependence on casual labor during this time period. So apart from the quality of jobs and economic opportunity reducing and possibly driving the squeeze on household incomes and budgets, we've also seen a sort of a shift in our demographic pattern, our demography. Increasing numbers of youth of secondary school age particularly, which is also, and sort of an increasing burden of care for households, so somehow an increasing sort of ratio of dependence to income earners. So we've got income earners having to support people within their household and their wider network, who are both older and younger. And particularly with the premium on secondary education and this fantastic expansion that we've seen in secondary education, there's also a lot of pressure on household budgets to pay for secondary school in particular. In addition, this slide shows the proportion of the population who are receiving remittances over this time period. And we see during the pandemic, between 2019 and 2021, there was a huge increase in the percentage of youth who were dependent on social transfers. We've seen a similar increase in those of what we call retirement age over 65, although I'm certainly not intending to retire at 65, but anyway. But, you know, our elderly population. But what's so interesting about that, and I think it came out in one of Mariangela's slides where we saw that those who are retired actually fared the best during the pandemic. We see that, you know, there's an increasing access to government social pensions for the retired population. And I think this really underlines a sort of a pet you know, project of mine, really, which is to make the case for the fact that social transfers are so important to supporting the conditions, not only for well-being, but also for growth. We've really seen the impact of that somewhat on the elderly population with the older person's cash transfer. Now, what have been the implications of this scenario for finance? So here, for one of our metrics, actually, which relates to the last chart, is showing that, you know, the increasing proportion of savings and credit which are being used for education purposes. So we've seen a big uptick in that between 2016 and 2021 across the population. Actually, the steepest uptick in payments for education or investments in education through finance has been for the poorest, interestingly enough. The poor have a huge premium on education, we often find. We've also seen that in this context of sort of reducing liquidity and the squeeze on household budgets, we've seen that finance for short-term needs and emergencies has become the predominant use case for savings and loans, rather than finance for investment. So finance for emergencies is the red line, the investment finance is the pink line. Interestingly, for the wealthiest, although they still have the highest level of use of savings and credit for investment, we've seen that their use of savings and credit for emergencies has actually bypassed that. So that really shows the pressure on those wealthier groups. This shows that the kinds of financial services that have been used really over the past, since 2016. We've seen a big uptick in saving with a mobile money account, and a sort of corresponding decline in people who are saving informally and through a bank or a non-bank financial institution like a SACCO. We've also seen a big uptick in the use of formal digital loans, mobile money overdrafts being one of them, and also in social network finance and loans from shopkeepers, family and friends. So that's what the sort of changing pattern of the usage of different financial services is somehow quite closely related to these patterns that we're seeing with respect to financial health. Both are obviously influencing each other, but you know, declining levels of financial health are leading people to sort of turn more to digital offers, which have fairly low barrier to entry, and social and informal finance. So I just wanted to just have a few sort of concluding thoughts here, but really this is questions. I think it's really the audience to help me make sense of all this. But you know, in terms of thinking about, well, how can we turn the situation around? How much power does the financial sector have, particularly through financial inclusion, really, to turn around the situation that we're seeing with regard to financial health? I think that's really quite a valid question. I mean, financiers might argue that, look, with all these declining trends across the economy, declining opportunities, you know, rising pressure from inflation and so forth, there's not much wiggle room for the financial sector to be able to offer meaningful products and services that can actually improve people's well-being and incomes and opportunities. However, you know, we've certainly seen in some of our analytics, we did a paper in 2019 which showed a strong correlation between financial health and, for example, savings behavior, and yet we're seeing a big uptick in the use of credit, formal credit, mainly for consumption. So how can we encourage more savings? How can we sort of encourage this saving behavior which has been shown to support financial health outcomes? Similarly, you know, how can we develop solutions which are more tailored to livelihoods and which can stimulate growth and investment even within these difficult conditions that we've got? And that kind of leads me to the next one. I think there's a lot of opportunities in the information universe. I mean, the digital universe is able to capture incredibly granular information on a very sort of rich range of segments. So even within businesses, for example, if you're a metal worker on the one hand versus a hairdressing salon on the other hand, I mean, you have very, very different business dynamics, and you're subject to very different forms of seasonality. Having the data available through these digital trails on the sort of liquidity flows of those different segments could actually help the financial sector to really create tailored products which would enable them to bridge their liquidity needs and actually perhaps support growth. So there's still a lot of wiggle room, I would argue, for the financial sector to do a much, well, I would say better job, really, of supporting growth as well as resilience for lower-income households. But we also need to accept that, you know, finance is impacted by a much broader range of factors within the economy and not just by financial inclusion. And here again, financial sector has a very important role to play as a key driver of the economy at macro, meso, and micro levels. So how can we get those macro flows to be sort of really driving inclusive growth? What can we do at the meso level, working with firms and businesses and at that kind of middle layer of the economy to stimulate growth that can actually create jobs? We had a long discussion on that yesterday in the Economic Opportunity panel. And that really does point to the role of finance, I think, at all these levels in catalyzing inclusive growth. So I just want to leave it there and hand over to Francis Guerre, my colleague from FSD, who's going to be moderating our very distinguished panel today. And we will hopefully be able to discuss some of the issues that have come up in the papers. Francis, over to you, and please could the panelists also, for the first panel, come to the stage. Eva, Rob, Andrew, I'm not quite sure if I've got all the panelists' names right in my head. And then we have Adano, Dr. Adano. Thank you very much.
My name is Francis Guerre. I work at FSD Kenya as a financial sector policy specialist. And it is my extreme honor to moderate the first panel for today. And we are privileged to have with us a stellar cast of individuals, both from public, private, and international organizations, who in their own ways contribute and work towards the topic of our discussion today morning. So before we dive straight into the substance of the panel, I'll request my panelists to introduce themselves, state their name, the institutions that they represent, and their roles within the institutions. Thank you.
Good morning, everyone. My name is Eva Mwasho from the Communications Authority of Kenya. I'm a senior analyst, and I work in the Competition Management Department.
Good morning. My name is Rob Burnett. I work with a youth-facing media business called Shujaz Inc. We work with young people across Kenya and Tanzania. We make media that reaches them and helps them to think about the future in different ways. And then we run very thorough research activities to try and understand what's happening among young people in East Africa. Thank you.
Morning. Morning, my name is Andrew Young. Work at Safaricom, specifically at M-Pensa. My role is I'm a lead for commercial management within M-Pensa, just looking at how do we drive more value for customers and also be able to have more insight-led decisions that can get better customer outcomes as we engage with pretty much the population of Kenya. Thanks.
Good morning. My name is Adano Ario. I work at Competition Authority of Kenya. I direct research and policy, and I support competition and consumer-related research and complaints analysis.
We have one more who is joining virtually. Are we able to dial him in?
Yes. Do you hear me? Good morning. Do you hear me?
We can hear you.
Thank you. My name is Luis Treviño. I'm the Senior Policy Manager of Financial Inclusion Data in the Alliance for Financial Inclusion, a network of financial policymakers promoting and enabling policy solutions for financial inclusion. And Central Bank of Kenya and other organizations in Kenya are members of AFIS, so it's really a pleasure for me to be here this morning. Thank you.
Thank you. So I want to start with Dr. Dano. One of the frameworks that Christine from CENFRI put up on Kenya's competition and consumer protection framework is the Competition Act. And sections 55 to 70 of the Act give the authority broad mandate to oversee consumer protection in the market, including addressing issues related to customer complaints and unconscionable conduct. From the authority standpoint, what could you say are some of the key consumer protection concerns and risks that you see in Kenya's financial services sector?
Thank you, Francis, and I would like to thank the organizers for inviting the authority. And the section of the Competition Act that Francis alluded to basically outlines the provisions of the Act in relation to how we handle consumer issues and also consumer complaints. Having said that, with regard to concerns, we look at concerns in terms of sector complaints that has been submitted to the authority. Therefore, over the years, we have seen growth in consumer complaints, and more particularly, we have seen over the years as well that about 60 to 6% of consumer complaints, of all the ones that we handle, actually come from financial services sector. So that has been growing over the years, and we have seen that complaints are actually indicative of people's engagement with the authority and as well as the sector. With regard to risks, I can more broadly give 4 risk patterns that we have seen. One is with regard to disclosure and transparency. That key services that are provided by financial institutions, they don't disclose or they are not transparent with regard to fees and charges. Therefore, those becomes complaints that are submitted to the authority for analysis and also for remedy that might be offered by the law. And the second one is unconscionable conduct with regard to providers filling of forms that relate to loans and borrowing by the consumers. So what we have seen over the years is that forms that are filled in by consumers are often not completely filled in. Therefore, there are areas that remain gray with regard to financial service providers, and therefore how that translates to additional costs for consumers at the end of loan repayment, for example. And the third one is unconscionable terms and conditions. Most of the conditions and terms in the loans agreements tend to be more legal in the sense that they are very difficult to understand by consumers. And they also tend to be lengthy, spanning 3 to 4 pages of the agreement. Therefore, this becomes of challenge to consumers in terms of understanding what are the legal interpretation of those terms and conditions in the agreement loans. And the fourth one is relating to unavailability or rather ineffective dispute resolution mechanism that exists between the providers of financial services and the consumers. In this sense, what I can say is that if there are any disputes, if there is any disagreement between service providers and the consumers, are there mechanisms which addresses those complaints by the consumers. Therefore, those are broad, in more broad sense, the 4 risk areas that we have seen from the analysis of consumer complaints that have been submitted to the authority. Thank you.
Thank you. And would you say that there are certain segments of the market where these risks are perhaps more pertinent than others?
What I've said is the fact that the way we analyze consumer complaints is looking at complaints that are brought to us. In rare cases, do we go into the market to find what are the some of the areas of issues, but based on the analysis of complaints that are submitted to the authority, we do see that financial sector accounts for about 60%. Others are all other sectors of the economy, because the mandate of the authority covers the entire sector of the economy, as opposed to also specific sector regulators which look at the specific sectors.
Thank you. Turning to Eva. So the first paper that was presented today morning by M-Pensa, showed that those who do not have access to mobile money services tend to be more excluded compared to other segments. And here it's not just excluded from financial sector, but also economically excluded. And from the standpoint of the authority, what do you think could be done to enhance access to the digital infrastructure that can then be the pathways towards these forms of financial and economic inclusion?
Thank you very much for that question. Indeed, ICTs play a very important role in enhancing digital financial inclusion. So when it comes to when it comes to infrastructure, there are three main issues that we look into. We look into access, which is the ability to access ICTs by end users. We also look at affordability of this affordability of ICT equipment, and also affordability of ICT services, and also availability of the ICT services. Now that points directly to infrastructure. So as the authority, there are 4 ways in which we ensure universal access to ICTs. So one is through market, is through the market. That's through the ICT sector has been liberalized, so we license various operators to roll out services into, to roll out ICT, different ICT services and infrastructure. The second way is through license obligations. So when licensees when companies are licensed, especially the infrastructure licenses, they're given rollout targets. So you'll be given say a number of sublocations that you must cover within the term of your license. And compliance is usually checked on a regular basis. And then the third way is through the Universal Service Fund. Now that's where now we cover access gaps where the market won't go and are not generally not economically viable areas. So that tend to be more rural, which speaks to actually the first paper that was presented, that most people who are excluded are actually in rural areas. So that's one of the areas of focus through the Universal Service Fund. And then the fourth way is through public-private partnerships. We are currently exploring how best to partner with different institutions to cover now the pockets that are extremely, extremely excluded. They're absolutely not economically viable, but they must be covered. So those are the 4 ways in which the authority is covering the infrastructure gaps. So we have various projects that are going on. So the first phase of the voice infrastructure project, which is aimed at providing mobile cellular services, which will go a long way in enhancing digital financial inclusion. So we aimed to cover 78 sublocations, and so far about 76, 75 have been covered. The second phase aims to cover about 101 sublocations, and the third phase is currently under the pre-feasibility phase. There are various challenges, very many challenges to covering those gap areas, and one of them includes insecurity. So you find that you put up a mast, the next day it's blown up, especially in the northeastern part of the country. We also have issues with terrain. The terrain is difficult to get to. People are living in, very mountainous areas that are difficult to cover. Or there are also issues of supportive infrastructure. There are no roads, so accessing those sublocations is very difficult. Access to electricity, there's no electricity in some of these areas. That's also another big issue. There's also community resistance, which is also another big issue. But in fact, those challenges are actually what are really hampering faster absorption of the funds and also faster rollout of ICT services in those areas. But the authorities currently, especially in the case of security, ICTs were designated as critical infrastructure earlier this year, I believe. And so that has also increased security around infrastructure that is built. And also we are engaging with different stakeholders and also different communities just to enhance community acceptance of these projects. Yeah, so that's what you have so far.
And could you also just add a commentary on now access to devices, let's say smartphones? And I would want Andrew would also comment on that when it will be your turn.
Okay. Access to devices, smartphones, I think is a wider conversation generally to the general public, like in urban areas and the like. Is a general issue of how do we make them cheaper, how do we remove perhaps taxation, what is making them so expensive, how do we enhance, say, local manufacture. I think that's a wider conversation. But with respect to the authority and the interventions that we're making are specifically targeted at disadvantaged and vulnerable groups. So for example, we're looking into ways of subsidizing, say, the cost of import of ICT equipment specifically targeted at the blind, or also target also local manufacture, seeing how we can enhance local manufacture of equipment to certain vulnerable groups. Yeah.
Thank you. Turning to Rob. The first presentation again highlighted that the youth tend to be one of those segments that are excluded from access to finance, and I would presume by extension to economic opportunities. From your standpoint, what do you think is driving that exclusion within that segment?
Thanks. I think there's an irony here a little bit, because I think when you look at youth income data separately from other adult segments, at least in our research, we find that young people are performing quite well. Young people are generally more financially healthy than the average adults in the country. And yet they are, and there are good reasons for that, I think. As young adults, they tend to be living at home. More than half are living at home. They're not burdened by the kind of routine expenses that their parents have. They're not responsible for household finance. And so they're enjoying a consistently healthier situation than the norm. And yet, as you've said, and what we saw earlier, they're also significantly financially excluded. So there's a sort of tension there. But I think and even the financial inclusion, I think what we've seen is that it's driven mostly by digital loans and microfinance. So it's not sort of formal sector. But I think we also saw in, I think, Christine's presentation that in many cases there's I'm looking for your phrase, what did you say? Suitability, voice, and meets purpose are all three places where young consumers feel excluded by financial services. So there's a problem where banks really don't want to have young customers. Banks don't welcome young people into the services that they provide. They've sort of signaled that they don't want them, and we're seeing it again in the data we saw just now, that the design of products isn't suitable for all consumers, and particularly for young consumers. So the service may not be suitable for young people and their needs when they come fresh from school. They don't have a history behind them. They're not formally employed. And then on top of that, it's very expensive in most cases for young people to obtain financial inclusion services. We've seen a drop-off, I'm sure that Safaricom has seen it too, in use of M-Pensa, and it's a function of cost. Young people don't want to pay. So when we're talking about the young people that we've been observing, the high performers are earning 12,000 shillings a month. So even as high performers, they're still marginal in terms of their overall income. And on the $3 a day, which is what it breaks down to, the kinds of fees that they're having to pay for financial services to be financially included are prohibitive. So I think we would certainly agree with what we saw earlier on the screen, that there's a problem of product market fit. The kind of services being offered to young consumers, the financial inclusion services, don't yet meet the needs of the young people that we're working with, at least in Kenya. Thanks.
Thank you, Rob. And turning now to Safaricom, Andrew Young, and I think you'll tell us if there's any relation to the other Andrew Young. So, two questions for you. I think one, just to sort of pick up from what Eva said about access to devices, and again, secondly, to also give a commentary on Rob's perspective on the suitability of the products to meet the demands, sort of the needs of the youth. But also to now address the question that I had for you is that I think from the presentation on the Consumer Protection Outcomes Index, we saw that there's a positive trend across most of those variables, except one on those meeting purpose. And Safaricom has, over the years, been very successful in rolling out solutions, either through its own or leveraging other partners. And I just wanted to hear from you whether, as part of this process, there has been any surprising or unexpected outcomes, positive and negative, in the rollout of these products in the context of meeting the needs of low-income Kenyans.
Thank you. I think the presentations really speak to a lot of dimensions and facets of what we do. As M-Pensa, drives payment so that now we create the environment. We also be able to offer financial services that then empowers, and then now we are driving innovation. So I'll begin from the issue of devices. I think when you talk from a channel perspective, devices play in that scope. So if I can use my smartphone or use my feature phone. So as we move along, I think evolution puts it that now we should be able to do more on a smartphone platform. But the pricing of the smartphones a bit higher than people want to include for financial services. So I think Safaricom is looking at this from perspective of price. How do we enable more people to get on board to this? And so you have seen initiatives like Lipa Mdogo Mdogo, by helping you to have phones by paying 20 shillings every day till you pay off for the phones, so that they have better phones. Also, we have worked on distribution and being able to bring form factors that work within different geographical aspects. There are places by, as been mentioned, electricity is a problem. How do you have more longer battery retention phones and the likes, ones that can get signals even from remote places. And then I think the third thing is to see how then do we leverage to then accelerate some of the deepening or inclusion aspects of financial services. So maybe that's just from access to devices. In terms of suitability for youth has been mentioned. Youth forms a very big percentage of our, of our population, but we see they're not the leading in terms of the segmentation that we have. And I don't know, maybe we can align with my brother here. He says they're healthy, but the truth is they're also in the space whereby they're trying to go up the economic ladder. And you have challenges of unemployment, or maybe they have so much to do to catch up with those who are more financially stable. So what you see it is a little bit the older generation tend to have the money, but the velocity of what they do with the money tend to be very narrow and also not more of development type. They're more stable, but the young people who are savvy seem to, what they need is they need to be empowered more economically. So that's why they're more sensitive to price. And so I think some of the things that are coming across, it's the issue of awareness for, or maybe that we put as education, comes strongly for our young people. We assume they're aware, but they're not aware. They're more consumer mentality, but that education financially seems not to be in place. So we are looking at areas like that. And the issue of cost and affordability, I think we are going through an evolution of different factors. And the way Safaricom looks at it, it's the issue of affordability. It is, as we continue to innovate and grow, we want also to be able to pass that benefit to to pricing, so that now also there can be more inclusion. And so certain initiatives have come along, like, they make our, issues of devices to be more affordable, or they can be paid at a pace they can be able to buy. So we're working on stuff like that. So we are addressing certain things. For instance, also, I know this also may go with politics. We are the only institution that actually brought cost of credit down, whereas all the other institutions took it up. So some of these things is to begin to talk to what are these outcomes. I think young people significantly, we see a lot of push for them towards affordability, that they can be able to access much more and not carry the burden, of course. The issue of choice also is a big thing for the young people. I think they consume things in different channels. They want certain things that sit with them that border on innovation. So we continue to see how do we bring to youth more innovation. Then to things like gaming, the way they do their businesses, it is online. They don't need a physical place. They want to do their business from home. So we are seeing young people are, the way their choice works is very different, and it's away from the traditional days. So coming to the purpose index, I think it's been from the last presentation. I think the indicators are very powerful. Where we are, especially for M-Pesa, as we move into developing our platform to become more agnostic and to be able to help the economy more, I think one of the themes that we have from the consumer side is to move into the space of consumer health. So it's not just them accessing, having deeper financial inclusion, and thanks to broadening how many kind of categories of services our consumers access, because there's a lot that is not done. Some things today, at Safaricom perspective, there are big things in 2007 when we started, like sending money, but that's no longer the thing. Nobody in this generation thinks it's such a big thing. So we are moving into a space where we're looking at, yes, you have inclusion, yes, you're deepening even across the products, which is a level we're looking at now, but also how do we get to consumer health? So you'll be hearing Safaricom doing things like trying to bring things that are savings, culture-led kind of propositions that will be coming out soon. May not mention, but some of them have been approved. So we're looking into those kind of space. And for the youth, what also we are trying to do, we are working in a space to see how do we begin to bring inclusion even for high schoolers to begin to have awareness, so that by the time they are coming into the major population space, adulthood, they're already more literate, and therefore the issue of purpose can fit better. But where we are from looking at the way, because of our needs are short-term, and therefore we go for short-term facilities, which then has driven the issues of loans, which are expensive and are a burden. The issue of purpose is coming more and more, that our consumers need to be educated more in terms of the responsibility and the fit for purpose for different products that we take up. And so when you look at challenges in the economy, I think sometimes we are dealing still with the basics of the economy, because if you have to eat, then somebody will borrow then to eat. So sometimes what they're borrowing or the product they're using is not sustainable for the kind of challenges they have. So we continue to innovate and see how do we position different products that then meet outcomes in the long term in terms of affordability and then purpose. So we are trying to shape that conversation. So one of it is awareness in a big way, education, and also being able to position different products for different purposes.
Thank you. Turning back to Rob, the paper on financial health, it showed that payments for education is placing a strain on income, and especially for the poorest. And for the segment that you work with, that is the youth, what are some of the mechanisms that we can put in place to ensure that these investments yield some dividend for the youth?
Thanks. I mean, I think it's a natural response, isn't it, for parents to want to educate their children. I think for the poorest segment, of course, it's what we spend our money on, and I think that it's troubling to see. I think from the chart we saw earlier that it's the poorest amongst us who are spending the greatest proportion of their income on their children's education. And I think it's tragic in a way, because the future is not bright for educated children. That we've been running an annual cross-sectional national youth survey for 7 years, and at no point have more than 5% of 15 to 24s told us that they have a formal job. So there's a terrible cruelty that we've indicated to our parents that their children will enter the formal sector, that there are jobs waiting for them, and that if they work hard and if they study hard and if they invest what they have in their education and their college and so on, that there's a formal sector job waiting. And what we're seeing is millions of families going into debt to buy an education that then does not secure the formal, that white-collar job that they're dreaming of. And it puts a terrible tension, I think, into the lives of young people, because they're under such pressure that their families have invested in them. Their expectations are so high that surely you are our investment, young person. So when's the job? When are you coming back to support us? And yet there are no jobs. And there's a syndrome that there's a vulnerability there, that actually what's happening, what we're seeing is that in fact, for many people, more education means fewer opportunities. That actually people are educated for something they can't obtain. And it's very difficult for a highly educated young person to accept the informal sector reality that waits for them. Another framing of that is this idea of cruel optimism. You've been told to be hopeful, but the truth is you're going to have to settle for something less. And that's a very hard thing for people to do. I thought I was going to get a white-collar job, but now I realize I'm going to have to be a hustler. And that's a tough one for people to accept, to turn back and pick up the reality. So there's a big problem, I think, where the education system and society and all of us are promoting one track, which is the track towards formal opportunity, the track towards formal employment. And the education system is teaching people for that market. And the reality that 95% of the million or so young people who will enter the job market this year will never get a formal job. They're going to work in the informal sector. And that requires a different set of skills and a different set of aspirations. So I think perhaps what we're seeing with the new government, this notion of the kind of the hustler narrative, can be extremely helpful in that, because it will allow people to be proud of their informal sector lives. Because what we're seeing is that many young people are indeed flourishing in that space. Something like 25% of 15 to 24s are hustling in the informal sector. In fact, what we've seen since 2016 is a doubling of young people who are working. In 2016, we found that 47% of 15 to 24s were earning income. But in 2021, that number was 100%. Almost every single young person out there is finding some money to support their family. So I think it's supported by the numbers that we've seen. So the future is informal. The skills that young people need are the skills of the informal sector. The education system may not be currently the right path to acquire those skills. There are some other avenues available. There's some informal trainings, some informal systems, and increasingly informal types of employment in the gig economy and so on, that actually provide, I think, a better path, and for which we ought to be preparing our young people.
Thank you, Rob. You've mentioned the gig economy and providing other tracks that could lead to more economic opportunities for the youth. My question to you, Eva, is there a role for the authority in sort of enhancing digital literacy amongst the youth to sort of meet the aspirations that Rob has painted?
I'd say the role of the authority would have to be within the scope of our mandate, insofar as consumer protection is concerned. So for us, the authority's role is mainly to empower and protect consumers of ICT services so that they're more aware, to create more awareness and also more more ability for them to use ICT services. So we're looking at things like, okay, so are you aware of your rights? Are you aware of your obligations? Are you aware of some of the services that are there when there are issues? Are you aware of the channels of redress? And also issues of cybersecurity come into play. So how are you safe online? Are you, what are the risks that are there when you're consuming ICT products and services? And so our role and our activities so far have been mostly around that. But indeed, there's a lot more that needs to be done to enhance consumers' digital literacy, and a lot of programs that we can also partner with other institutions to enhance digital literacy. But largely, it's not, our role has mainly been towards consumer protection and empowerment as they consume ICTs in general.
Thank you. And of course, one of the institutions that you could partner with is the Competition Authority, Dr. Dano. And I'm also aware of the campaign that the authority has been running, I think, on Kachonjo, I think on just enhancing safety within the digital space. Thank you for that. Dr. Dano, on Christine's presentation, she had a graphic that showed the need to balance financial inclusion and protecting consumers. And I think there's a comment that she made that protecting consumers is not easy. And the authorities, competition authorities' mandate is in most instances enforced ex post. In simple terms, it just means that the authority will pursue any enforcement or remedial action after harm has been done. Would you say that this approach is effective when it comes to consumer protection?
Thank you, Francis. I think that's the issue with regard to regulation is at the core of both competition and consumer issues. And just for information purpose, the other form of regulation is ex ante, which means that issuance of license allows players to play in that market. And therefore, once, for example, CA give a license to any agency, then they're allowed to play in that market. Or if there are issues to do with trade, they will be also licensed to be active in that market. Therefore, that's ex ante, which is forward-looking approach to regulation. And as you put correctly, our role more so is on ex post regulations, which means we look at consumer redress after the event has happened. And therefore, what we do is either we receive consumer complaint of any harm that they have experienced or any misinformation that they have encountered. And those are the sort of complaints that we receive and we analyze. And not all consumer complaints are also taken forward for remedial purpose. For example, if there's no clear evidence that links the complaint to the substance of the complaint, then it's become difficult to follow up. However, in most success cases of complaint redress, what we look at is we receive complaint, analyze, and therefore take remedial action based on our analysis. The other option is for us to have an on-motion consumer complaint addressed. If we have any intelligence that indicate that there is consumer harm in certain sectors, then we do consumer analysis more broadly as per the sector, as opposed to individual consumer complaints. And in that line also what we do is we work with other competition agencies in the region, like the COMESA. If there are ban of consumer products that are harmful to consumers, then we can also recall those products from the market. But in terms of achievements of what the authority has done with regard to ex post analysis of consumer complaints, is we have gone into market and seen that some of the issues that regard to fees and charges are today disclosed. So you see if you are transferring, paying any bills for your utilities or transferring money to any relatives or friends, then you can see how much it costs you to send an X amount of money. So that allows us to have a proper approach to remedy consumer complaint. In financial institutions, we have also in certain instances followed non-deposit taking financial institutions and penalized them, and also compel them to pay for charges and fees which are not disclosed. So we have taken those measures to address a consumer complaint in that sense of ex post. And therefore what we have done is to follow the law and also see that consumer complaints are redressed. So in terms of actual implementation of Competition Act, we have not seen any gap in the law that allows us to reconsider and review, but there's an opportunity for us, if there is any gap that we experience on practice, then for us to amend the law and address consumer issues. But as of now, and I think it's comprehensive enough to be addressing consumer issues.
That is clear. We've not heard from one panelist. We didn't forget him. It was by design, and that is Luis. And he sits at AFI, and we wanted Luis to just give us a commentary, just to give us his thoughts from the pre-presentations and from the pre-panelists, or from the four panelists, on his perspective from a global standpoint on where Kenya stands compared with other countries in terms of financial health, consumer protection, and financial inclusion. Luis?
Thank you so much. Thank you so much for the opportunity. I want to thank the Central Bank of Kenya and the FSD Kenya and all of the partners for this conference and for inviting us. Really, well, I'm really pleased of this session. In terms of financial inclusion, my response would be that Kenya is. I have a very optimistic overview, right? I think has been evolving very positively, especially thinking and has been explained, right? And we all know the mobile money, digital finance is one of the key enablers, right? But I think it has expanded beyond just. I'm sorry. I'm so sorry. It has expanded beyond transactions, right? And it has been able to cover. And if you see the recent Global Findex results, Kenya is among the countries, especially the Saharan region, that have led, right, the financial inclusion, right? Of course, there are opportunities, right, and there are gaps, and I think the presentations today provided an overview on some of these opportunities, on some of the groups that still are not included, right? Especially thinking on rural, also on the gender gap that is still persistent, right? But in terms of gender gap, women financial inclusion has evolved positively, right? It has evolved, but has evolved in a different pace than men, right? If you compare this, but still, there are these challenges. Thinking also, looking at the presentation from CENFRI, from Christine. I really commend the work that they have done in terms of this index on financial consumer protection. I think this brings more information in terms of quality, right? That it's so relevant. And in these regards, the results that she presented are quite positive, right? We can see that choice, safety and security, and fairness and respect are very high rated, right? More above the 90%. That's very positive. Still, there are opportunities in terms of, and it was mentioned also during this panel, the recourse in terms of disclosure and financial education, right? At least the rates in this measurement are lower, but still are quite positive, right? Another aspect, I think that's very important, the one mentioned on suitability of financial products, right? That it's also it's a challenge not only in Kenya, in all the countries, right? To really fine tune the financial products to be suitable to populations, right? And we can see here, for instance, that there's an opportunity in terms of reaching out more rural population, right? Youth. but especially I think rural, not so much youth. So that, I think that there are opportunities that well, in terms of that requires partnerships between the different stakeholders, the policymakers, but especially also the private sector, right? And it's and we are in this panel with different stakeholders. I think and in terms of financial health, we have been discussed also in AFI, and it's right now one of our key thematic areas, this financial health in terms, not only on measurement, but also in terms of the other related policies. And financial health, we see this as measurement. In terms of measurement, we see this as mentioned by UNSGSA. It's like a temperature, right? It's like having a quick temperature of how is the financial health of the economy, right? Of the different sectors, right? Of course, and I think it should not be surprising for us the decrease in financial health, especially in the last finances, given the very difficult context, right, that was lived not only in Kenya but in a global scale, right, in terms of disruption of employment, disruption of value chains. This has a negative impact in every way. So well, we should expect, right, that a decrease on this. But still, for instance, the aspect of what that's mentioned on families investing in education, that I know that and the panelists here also have a kind of a negative opinion, but I think in terms of financial health, that also tells us about how it has been, families are thinking on long-term goals, right? That are investing in long-term goals. Of course, there's the markets are the markets always, there's a structured economy, right? But in terms of in terms of education, and also thinking in this context, we can see that these last 3 years have suffered a disruption in education, right, at all levels. So we should not be surprised to have this, like families really trying to invest more in education, because the education was disrupted in a global scale. Yet this can also provide some important information for making decisions in the long term in terms of public policy, right? In terms of how can education be supported, right? In these terms, and also what was mentioned, I think was important in the panel, not only education with the focus on formal employment, but especially on really form and develop skills for entrepreneurship, for SME, for developing the economy, right? And we know as many countries, I am from Mexico, and also in Mexico, the informal economy is very, very high. But in that regards, investing in SMEs and entrepreneurship, and also financial inclusion can be factors that eventually reduce the level of informality, right? In the long and medium term. So. I'm really quite optimistic right now. I'm not so pessimistic in terms of, we know there are a lot of challenges, and the context right now, it's very difficult. But in terms of financial inclusion, I think Kenya has done the right steps, right? Also, we can think right now, before the conference, there was announced the launch of the payment system strategy in Kenya. That also it's an important, right, payment systems innovation to also expand the different financial services offered, right, to the population, not only the transactions. And also in another way to also keep the safety and security of the financial system. I think that I'm very optimistic right now. I know there are a lot of challenges ahead, but I think the Kenyan authorities and also the private sector are in the right path right now. Thank you.
Thank you, Luis.
Sorry.
Thank you, Luis. And on that positive note, we've come to the end of our panel discussion. I want to thank all the panelists. And can we give them, or can we appreciate them? Thank you. Who?
Thank you so much, Francis. Thank you, Louis, from AFI. AFI was one of the funders for the FinAccess survey. Also want to thank all the panelists. I know we are hoping to have questions from the audience. I don't know whether we have any questions. I know we had one online. Okay, I see one there from Adrian, right there. But from the audience, as we wait for Adrian to take, we had one for Daktari about the mechanisms that consumer CAK is taking to come up with the mechanisms you talked about. And I know you've already mentioned them, but you could probably just quickly say one or two mechanisms that you're taking to protect the consumers.
Yeah, thank you. In terms of handling consumer complaints and how we redress them, as we said correctly, the fact is that we address consumer issues ex post, which means there's already grievance between the consumer and the service provider. And the way we do that is we receive complaints either physically at our offices and Kenya Railways, or we can also receive them online. And once we receive them, we get in touch with the complainant and see if there are evidence to support the complaint. And the first point of instance is to reach out to the service provider to ensure that there's concurrence between what the complainant is saying and what the service provider says. So there's what we normally call a hearing conference. We call both of them and verify that's the fact actually on the ground. And in some instances, they actually agree to resolve the issues by themselves. But in absence of that, if we have enough evidence to show that consumer is actually on the right, then we can penalize the parties. And therefore, that becomes part of our remedial measures. But what is key in all this consumer complaint is the evidence. And consumer can come to us and complain, but if it doesn't have evidence, then that becomes a very weak complaint. Therefore, we cannot pursue it further. But what I will urge, what we do urge consumers in most cases is to ensure that they have proper documentation to support any complaint. And if they purchase products, they should have receipts that show that evidence. Or if it's a purchase of a product online, there will be communication to that effect. And if they have already addressed it to the service provider, then they have not taken any action, then that can be brought to us and we can handle them.
All right, thank you. Thank you, Adano. So that was from Dr. Martina Mudeo from University of Nairobi. So we can have the next question. Just need to say your name and the institution and then who it's directed to. Thank you.
Okay, thank you. This is Adan Shibia. I'm from Kipra. Just two questions to Dr. Adano. One is the analysis report, the complaints analysis report. I wanted to know whether, as part of the policy conversation on the subject, whether CAK do publish and the regularity of the publication in terms of the nature of the complaints and then per sector. I think that's also part of it helps in terms of taking forward the conversation. Then secondly, you identified 4 risk areas, which I think can also be viewed in terms of the challenges. Perhaps maybe just focusing on 2 areas, dispute resolution and perhaps terms and conditions. what opportunities do you see for improvement, perhaps? I think as a country we have done some positive steps over the last years, perhaps. From your view, what more need to be done? Thank you.
Thank you very much for those questions. With regard to the first question, almost all the consumer complaints we handle are published on annual basis, and our annual reports are available on our website. So those can be accessed by anybody or public based on their interest. So those are available on our website, and you can access them. And also within the annual report, they are provided as per sectors. But there's a long list of annex in terms of all the consumer complaints that we have received within a given year. But one of the challenges we are facing of late is the number of complaints we receive. In the past, they used to be in the tune of 50 and 60. Now they are going to hundreds, 300, 200. That's what we are receiving. So they make the annual report voluminous, but they're also available on our website. In terms of the risk areas that mentioned earlier, particularly with regard to unlimited mechanism for providers to resolve complaint, there are two areas which we have seen more prevalent with regard to issues of relation between buyer and suppliers. And what we have developed is what we call code of practice. Code of practice are developed by players to ensure that among themselves they are able to regulate, and that allows the authority to just oversee or becomes the third party to play in that complaint process. So what we have done, therefore, is to ensure that they handle among themselves first, and therefore, if they are not able to resolve them, they can come to us and we can handle the complaint on their behalf. In terms of financial institutions, where I've mentioned about unconscionable conduct, is those ones are actually handled very well within the provision of the law. And one thing that maybe is becoming more difficult is with the digitization, most of the information or evidence takes place online. Therefore, we cannot access directly, or in some instances, complainants cannot access them directly. So that's one area I think that we have to look at. And as Francis mentioned, we do have an MOU with the CA in terms of how we look at those issues. And there are instances, not in financial sector necessarily, we have resolved issues of that nature.
All right. Thank you. I think we have time for one more question because of time, and I think we'd have to figure out how to manage the next session. So you can quickly ask your question. Then
my name is Annalise McKenna, and just a follow-up from Dr. Ray from the Competition Authority. Just wanted to ask whether the public is aware of your authority and the level of awareness.
All right. Terry can quickly respond to that, then we. Yeah, thank you.
Thank you, McKenna. That's actually one of our strategic objective as per our strategic plan, in terms of public being aware or not being aware of our mandate and whom to approach in terms of any complaint. In terms of consumer issues, there are also sector-specific regulators who handle specific issues within their mandate. What happens is that we have more than 10 memorandum of understanding with sector regulators that in areas of concurrent jurisdictions, we can resolve issues together. But in terms of informing the public of our mandate and how they can handle issues, both in terms of competition and also consumer, is on annual basis we have annual training where we build capacity of our stakeholders. And stakeholders include all the sector players, all issues that relate to energy, telecommunication, lawyers who present businesses, in terms of any complaints or any business practices, which in our view are not in line with the provision of the Act. In terms of consumer-specific ones, the strategic plan also provides for us to collaborate with consumer bodies. And we have worked with a number of consumer bodies. What we see as a main challenge is how to reach to individual consumers in large numbers. But consumer bodies allows us to reach to the relevant consumer bodies in that realm of areas of concern. So I'm aware that we have tried to reach out to consumer bodies, and also taken one of the annual events of the authority. There's a World Consumer Rights Day that we take to different counties on an annual basis. We have been to Kisumu, we have been to Kakamega, we have been to Eldoret. Of course, we are in Nairobi, and therefore awareness of the authority within Nairobi is higher, but it's much lower in other counties.
Thank you so much. So,